What is a mutual fund? I see a mutual fund very much like an ETF, where it's a fund that holds a mix of many different assets like stocks and bonds. The main difference that I see between them is that an ETF are passively managed, where mutual funds are actively managed by a professional money manager in an attempt to generate better returns for the investor. Today, I want to go over one question. Should you invest in a mutual fund? On paper, it sounds like a no-brainer. Why wouldn't you want a professional money manager managing your account? An actively managed account should generate better returns than a passively one, right? Why else would you manage it if you didn't? But what a lot of people don't know is the fees associated with a mutual fund. Having someone actively manage your account is never free. It's the way that they're billing you that you don't know exactly how much you're paying. You never see on your return statement stating, "Oh, this is the management fee." The management fee is deducted right from the fund, and whatever is left is the investor's return. So all you see is your returns, and as long as it's positive, you're happy. What if I told you that banks could be charging you around 2% of your account value as a management fee, whether they make you money or not? This is 2% of your account value, not your returns. And if you're thinking, "Oh, this is fine as long as they're making me money," well, today I want to show you the difference in your returns, and you'll be shocked at how much you're losing out on. So in this first chart, the line in red is your account return over a period of 31 years. I'm assuming an annual return of 7% per year and a management fee of 2% yearly. So if you invest $100 in the beginning, after 31 years, you can expect to have over $450. So that's a return of just slightly over 350%. Not the best return, but it's okay, I guess, for not having to do anything. But what if I told you without the 2% management fee and with the same annual return of 7%, you could have over $800 or just over 700% return on your investment? The reason why I chose 31 years is because that's exactly when you have earned more than double what the mutual fund would have earned you. Initially at the beginning, the first few years, the difference between the two isn't very large. It's over the long term that the difference builds up, and through the power of compounding, it widens the difference. I charted out the different management fees ranging from 2% to 1/10%. This management fee plays a big role on your return investment over the long term, all because of the power of compounding. The power of compounding is amazing. Even with a very small amount, over a long period of time, you can expect massive returns. That 2% management fee that is taken out every year isn't being compounded into your returns. So just by contributing that extra 2% every year, you can see the massive difference it made. It gets even worse the longer the time frame you're looking at. I charted over a period of 100 years, and you can see the difference it makes. Compared to 2% management fee, you can expect to make over 650% more. Most likely we probably won't be invested for that long, but what I want to show you with this chart is something else. If you take the lower management fee, mainly the 0.5%, the 0.25%, and the 1/10%, the difference between those and the no fee isn't so bad. Don't get me wrong, over an even longer term it will make a big difference, but because our lifespan is only so long, if we look at it based on investment time frame, the smaller management fee hasn't quite gotten out of hand yet. We can see this in the numbers. There still is a difference, but overall, it's not so bad. This table here shows you just how many years it takes for the no fee account to at least double the account with the management fee. You can see that with the 2% management fee, it only takes 31 years to double, and that is within our investment time frame. But when you take a little lower management fee, it takes a long time, over 100 years, and that is well beyond our investment time frame. If we take a look at something more reasonable, say 50 years, you can see the difference is acceptable. So if you can find a very low fee mutual fund, it won't erode away all your profits. Or you could invest in a low fee ETF, which is probably going to be much cheaper when it comes to management fee. But at the end of the day, it all depends on your investment time frame. The longer the time frame, the more you should be looking at lower fee products. And as always, if you enjoyed the video, please like and share the video. It really helps out the channel. And if you haven't subscribed yet, please make sure to smash the subscribe button. And thank you for watching. I'll see you in the next video.